That's closing bell on Wall Street, and now it's market domination overtime. We are giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Bob O'Donnell, as well as Yahoo Finance's Allie Canal, joins us here to break down the moves today. Allie, let's start with you on that close.
All right, it was a nail biter here. I think we're just making it. S&P 500, new record here. Nasdaq Composite also eked out some gains, another record. Dow, we are off from those record highs, but still we are up around 200 points. So really big day here, especially considering we had a lot of trade headlines. We know that Trump has been ramping up on those tariff letters. We have the copper tariff, 50% there coming August 1st. But despite all of this, markets looking past that. And then if we take a look at the big tech names, particularly Nvidia, you're going to see on a market cap basis, we closed above 4 trillion for the first time ever. Nvidia was able to hit that 4 trillion market cap during yesterday's session. We did not close above the 4 trillion market cap, but today we did there. So just a really solid picture here on Wall Street. If we take a look at the sector action, you'll see tech was the biggest laggard. Financials, though, leading, healthcare also leading, and then communication services seems to be another laggard here in intraday trading. So overall, just a strong day when you think about the record highs that we've been able to secure amid this rally, just this intense comeback from those April lows. A lot of retail buying. Strategists on the street say that we have more room to run. We got price targets earlier this week from Goldman Sachs along with Bank of America. They raised their respective S&P 500 targets. So it just seems like there's a lot of momentum in this rally right now, Josh.
Thank you, Allie. And Bob, just your quick thoughts on Nvidia and specifically, what a move off that April low, Bob. And you say, you know what, more potential positive catalysts ahead.
I absolutely do think there's still potential. Again, I mentioned it earlier, the whole notion of what Jensen likes to call physical AI, robotics. There's industrial robotics. There's obviously eventually personal robotics. There's all kinds of places where I think there's opportunity. And again, to give him credit, he saw the robotics thing much earlier than most people did in terms of investing in platforms, not just individual chips for robotics, but for software platforms there, as well as he did with CUDA for AI. And he's now leveraging that. And again, he's able to take not only those robotic-specific platforms, but then combine them with the AI capabilities. And that opens up, again, a lot of interesting potential down the road. So I still think there's some upside there.
All right, moving on. Joining us now is Neil Mukherjee, Chief Investment Officer at TIAA Wealth Management. That firm has more than $1.3 trillion in assets under management. Neil, thank you for being here. So you come on a day, Neil, SPX, the S&P 500, and the NASDAQ closing at records here. Neil, you say hold on because for the SPX, you say maybe upside is limited in the second half. How come, Neil?
Yeah, listen, the equity market has clearly been in a very sweet spot in recent times. The trade tariffs have basically, some of them have been put on pause. There's some renewed tensions right now. We've had the big, beautiful bill that has been now passed. Corporate earnings seem to be doing well. The economy has been fairly resilient.
It all sounds good, Neil.
It all sounds really good,
Yeah.
and the economy is doing well. But I think the forward-looking view, at least from our perspective, is that the economy should slow down. The impact of tariffs on inflation is still to be felt. And I do think that with the S&P trading at nearly 22 times earnings right now, I think it's time for a bit of a pause, which is why I would look for opportunities below the index, because there's a lot to worry still about the economy from the impending tariffs that are already out there.
And Neil, that economic slowdown you see, that's not baked into earnings expectations in your opinion?
I don't really think so, because if you look at the economy broadly, just stepping back, the economy has been very resilient as of now. But if you look at the labor market, it is cooling down. Companies are on pause as it relates to hiring. They're not laying off workers, but they're basically frozen right now. I think in the very near term, there's some capital expenditures which are still on hold. You have to assume that is the case, even though AI CapEx is on fire right now. And then you look at the consumer, and there's just mixed stories about the consumer economy, right? We know that the low-income consumer has been struggling for a while, but the high-income consumer has really been taken the baton and really, spearheading consumer spending, so to speak. But Given that the high-income consumer, the top 20% of the consumer now account for 40% of consumption, and 36% of their net worth is in stocks. So given the gyration in the stock market, we have to wait and see if that impacts their spending. Some retailers are indicating the high-income consumer is getting worried as well. So that's something that I think still is going to come. So our forecast is that the economy will step lower to a 1 to 1.5% growth. That, I think, is still not factored into earnings estimates.
And where's the Fed in all this, Neil?
Well, that's the million-dollar question, right? So if you look at inflation, the Fed is still focused on inflation. They're a little bit worried about inflation. Inflation still hasn't been impacted by these tariffs, which has surprised a lot of people, for sure. But that's happened because the service sector inflation, that's come down. Inflation has come down generally because of oil prices staying lower as well. But the Fed is focused on inflation because they're worried about goods inflation, and that will accelerate. If you look at the inflation forecasts out there, they're estimating it's going to be about 3% for the next 4 quarters. So it's
what
one
are the
thing
odds,
for
Neil,
yeah.
that tariff inflation boogeyman never shows up?
There is some possibility that it never shows up. I do think it'll show up in the goods part of the inflation. Now, we can debate what the impact of tariffs on inflation is. Some of this may be absorbed into the expenses of the exporting countries, exporting companies. They will negotiate their way a little bit.
Well, it's interesting you say, because even when you heard Jay Powell saying now, he's having a tough time sussing out who eats it, right?
Exactly.
Consumer, producer, seller, some combination.
Yeah, and the combination is, it depends on the industry as well. So it depends on the players, the profit margins, the competitive situations. It depends on if the consumer can actually substitute out of those products. So it's industry by industry. We did see prices of washing machines, for example, go up in 2018. But nevertheless, the longer these tariffs stay in place, and tariff rates are effectively at 14%, it's way higher than the 2.5% tariffs at the beginning of this year. The longer this level stays in place, at some point, the companies will have to pass it on to the consumer, and broadly that will show up into the economy. Again, I'm not saying that it's going to be runaway inflation, because there's other parts of the CPI basket which is moderating, like the service sector inflation, as well as housing inflation. We're in early days where home prices are beginning to trickle lower. That will feed into the inflation basket as well. So broadly, you asked about the Fed. If inflation is at, let's say, 3%, and the Fed feels like the labor market is cooling, but they want to really get ahead of it, and more of the Fed officials start to skew more dovish, you could expect the Fed to cut interest rates, maybe not in September, perhaps in October, at least 1 or 2 times for the rest of this year.
So let's add this up. So given the backdrop, the environment, your expectations, how do you want to be positioned in the stock market?
Yeah, listen, Josh, the one thing that we always talk to our clients at TIA is we lead with financial planning. So we tell our clients, so the situation is different for everyone, right? We tell our clients,
your cash, your courage, your time horizon, right?
100%, right? And we ask them to be in a diversified asset class structure. We ask them to have diversified sources of income which can supplement their living expenses during retirement as well. But having said that, in the here and now, generally, as I said, we expect the economy to cool down. We expect the Fed to cut interest rates. We do expect deregulation initiatives to come into better view. We do expect capital expenditures to perk up because of some of the provisions of the OBB. Now, this is a good environment for equities, but like I said, with equities already at 22 times earnings, we look below the surface. So financials, I think, can continue to do well. Deregulation, productivity story, they're not that expensive. We like certain parts of the market which are leveraged to the AI CapEx theme. So it could be certain ideas within technology, communication services, utilities, industrials, engineering and construction companies as well. And then we like global diversification. So when you think about tariffs, it's detrimental to some of the other countries out there, but it forces other countries to invest in themselves. Infrastructure, defense, supply chains. That helps them, coupled with the fact that they have reasonably good valuations, that helps those industries and those companies. So that global diversification theme has some legs, and retail investors tend to ignore international investing because they've done so well with the S&P 500. This is the time to go back and make sure you have the right amount of international exposure in your portfolios.
Final question, for fixed income investors who are listening right now, what's your advice?
Yeah, listen, I think bond yields in the very near term can go higher, but towards the back half of the year, I would expect bond yields to start moving lower as the US economy slows down. So we think that if you stay in a diversified basket of high quality fixed income securities, you can get 5 to 6% yield. depending on the kind of duration you're taking, and that is a very good place to be given where inflation is. And also, I would try to fade the low quality side of credit as well, because you're not getting compensated for some of the risks that we talked about.
Neil, great to see you, especially on set. Thank you for coming
Thanks
in.
for having me.
Levi Strauss earnings just crossing the wire now, and Brooke DePalma has the results. Brooke.
Good afternoon, Josh. Certainly wowing the street. Stock up nearly 8% in after-hours trading. Retail comeback for Levi's here as they really stand out this year so far. The stock up more than 30%, and now this stellar report out from them after hours here on this Thursday. Adjusted earnings per share, revenue beating, also the company raising their outlook. That's what has Wall Street excited right now. Taking a closer look at the numbers, adjusted earnings per share came in at 22 cents versus what Wall Street had expected of 13 cents. We also know that revenue also came in higher at $1.45 billion versus what Wall Street thought was going to come in at $1.37 billion. CEO Michelle Gass saying in the release that they delivered another strong quarter. She said that reflected broad-based strength across the board and clear evidence that their strategic agenda is gaining traction. They also said that they're entering the second half of this year in a very strong position of strength. That led them to increase, or rather raise, their guidance for the year. Now, it's important to note here that last quarter, they chose not to raise their guidance because it was the early April. Tariffs were just announced as retaliatory tariffs. Now, this new guidance assumes that U.S. tariffs on imports from China remain at 30%. It also assumes that the rest of the world has a 10% at the remainder of the year. They now expect net revenue to come in up 1 to 2% compared to a previously expected decline of 1 to 2%. Adjusted earnings per share for the year also expected to now come in between $1.25 to $1.30. Wall Street had expected $1.23. And if you take a closer look at my screen right here, we have Levi Strauss ticker page up. It's up nearly 8% once again in these after-hour tradings. Lots of excitement here, Josh.
Yeah, and Brooke, it's interesting. Chief Financial and Growth Officer, I see Harmeet Singh talking about that strong first half, talking about, as he puts it, the continued momentum across the business, and does say even despite the higher tariffs, raising those full-year revenue EPS expectations. What are you going to be listening for on the call, Brooke?
Josh, we're really going to be listening to hear more about how a retailer was able to overcome all the uncertainty that we've seen from both the tariff front and consumers. Ahead of this report, analysts were super intrigued by Levi's ability to really navigate these tariffs. They've been able to do that by those mitigation tactics that we've been talking about so much, but also that supply chain. If I take a closer look at how exactly they've been able to do that over the past few years, they've been able to change exactly where their sourcing comes from. They took their China imports to the U.S. down from 15 to 16% in 2018 to now just 1%. Also, last week, we heard about Vietnam now getting a 20% deal. Well, now they only import mid to high single digits from Vietnam. So certainly what we expect to hear is more of Levi's really touting that they've been able to mitigate the impact of these tariffs. They now source from 20 countries. We also know that 57% of its sales are made outside of the U.S. And in addition to that, analysts believe that they really do have the ability here to raise prices in this environment because of brand equity that they have. Everybody knows the Levi brand, Josh.
All right, thank you, Brooke. And by the way, Harmeet Singh, Levi Strauss CFO, he's going to join Yahoo Finance Friday to break down these results. Well, KBW out with a new note covering the banking sector, notably upgrading some big names like JP Morgan and Morgan Stanley. This coming as banks kick off another earnings season in the coming days. We're navigating how to play the banking sector with the Yahoo Finance playbook. And joining us now is Christopher McGrady, Managing Director and Head of U.S. Bank Research at KBW, a Stifel company, and Yahoo Finance's very own banking reporter. That would be David Hollerith, of course. Chris, it is great to see you. So let's just dig right into these names, Chris. JP Morgan, you're a fan, you upgrade to outperform. Now, I was just talking, Chris, to another analyst on this very show who was telling me, you know what, this one, it's too rich, Chris. It's too pricey. You obviously don't see it like that, so explain it to us.
Hey, Josh. Thanks for having me back. Yeah, JP Morgan, arguably the best well-run U.S. bank in the country. Quality banks trade at big premiums. And so the stock has definitely worked over the past couple months as the deregulatory narrative has made its way through the sector. But if you look at an earnings basis, the stock is not all that expensive compared to its own history. It's trading at a 12 to 13% premium. Last 3 years, it's traded closer to 10. The pushback we've gotten is the book value multiple is pushing 3 times. We get it, but also keep in mind the ROE at JP Morgan was 20% last year. And so high quality companies with that level of returns, we believe, should trade at high valuations.
Hey, Chris, how's it going? It's David Hollerith. I saw your note, and for the second quarter or so earnings coming out next week, it looked like you were actually kind of below consensus on profits for JPM. And I was just curious, looking into the picture a little bit more, what do you expect to hear from them next week?
Yeah, our preview will be out shortly. You know, our call is that the narrative for the banking sector this quarter is really going to be the evolution of what happened during Q2, right? When these banks talked to us in mid-April, it was the midst of the peak uncertainty on tariffs. So there's a lot of cautious optimism, a lot of caution heading into the next quarter. I think what you're going to hear this quarter is business improved throughout April, May, and into June. Capital markets activity is improving. The outlook for investment banking is going to be solid. And specific to JP Morgan, our call is a longer term call, right? The stock has had a big move. The ROE is moving higher. It's at a 20%. It's going to be in the mid-teens. And I think over time, the redeployment of excess capital, that is something we have to start putting a value on. Right now, it's hypothetical, but the capital relief that these banks are going to get isn't going to show up this quarter. It's going to show up over the medium term, and there's a lot of value sitting on these balance sheets. What
about Morgan Stanley, Chris? Another name you like. It's up about 15% this year. What do you expect to hear when they report?
Yeah, Morgan was a name we decided to upgrade as well. Really a high quality bank. They've really transformed the company to be more asset wealth management, and it's delivering one of our themes, this consistency of returns. So high teens ROE that's repeatable and with limited volatility. Again, Morgan Stanley is going to benefit from stability and rallies in equity markets. So we expect a similar narrative of building capital markets, trading, investment banking. But overall, Morgan Stanley, the reason we really like the stock and the entry point with our launch is it's actually lagged the largest banks year to date. It's up less than most of the universal banks. And if you look at the relative PE premium, it's currently trading at about a 12 to 13% premium. If you look back over the last 3 years, it's closer to 20. So it's lagged a bit, and that's a little bit of the entry point angle that we're playing.
And Chris, this is David again. Just thinking about Morgan Stanley and the rest of the big banks in terms of investment banking and deal making through the quarter. I mean, that has been the story. It was very gloomy in April, and progressively things have gotten sunnier. I feel like the question kind of now is how sunny. And I'm just curious on the calls when you hear from CEO Ted Pick and Jamie Dimon, and what are you hoping to hear from them in terms of the pickup in investment banking? Like, what do they need to say for you to feel like it is well in full force?
Yeah, I think it's, I wouldn't say we're at or near blue skies, right? I think, last year there was a lot of optimism that we'd be off to the races. It's taken a step back with the tariffs. But on the margin, the second derivative is moving in the right direction. So the outlook, I think the outlook commentary that I'm most looking to hear is what are the end customers saying? What is their degree of confidence? How has it changed over the past 3 months? And if you look at equity prices, there is a bit of a wealth effect. Higher market values make people more confident. So I would expect the outlook commentary, the pipeline commentary to be better than it was, certainly better than it was in April. I think the quarter will be a little bit irrelevant in terms of the actual results because the first part of the quarter was likely pretty slow.
Chris, David, thank you both, gentlemen, so much for your time today. Appreciate it.
Thank you.
Well, Samsung has debuted its newest foldable phones during its Unpacked event. Bob O'Donnell and Dan Howley both were in attendance. Bob, some of your takeaways on the Galaxy Z Fold 7 and Galaxy Z Flip 7. And you have the phone with you, I believe, right now, a handsome device. Give us your takeaways, Bob. What'd you make of it?
Look, it's amazing. I have been a devoted foldable phone user since what I call Generation Zero. So if you know the history of foldable phones with Samsung, the very first one they came out with, they recalled after basically 2 weeks because they had some serious issues. And literally, I had to physically return, like they sent somebody to my house to get the phone back. Then they came out with the regular Gen 1 through Gen 6. And there were always, the thing about foldable phones is it's the physicality of the device and what it's like to hold and use. The problem in the past was they were too thick and too heavy. And what they did with this one now is, it's 4.2 millimeters thin. Even when it's folded, it's only a 0.5 millimeter thicker than a standard iPhone or Samsung S25. And yet you get the benefit of, bam, 8-inch screen on the inside. And so that physical experience of having both a tablet and a phone in one device, now at the weight and the thickness that I think makes it more attractive, I think is really cool. The problem is, it's still a $2,000 phone, right? There's not that many people who buy $2,000 phones. And so that's the big challenge they need to overcome. But from a pure, sexy, cool tech device that you gotta have if you're into that, this is hard to beat right now. Dan, you were at that event, and I want your thoughts, because I know, Dan, some of your takeaways, you looked at foldable device, you said thinner, lighter. I think you also said puts Apple on notice, I believe.
Yeah, look, I mean, everything that Bob said is 100% right. These phones started out being kind of bulky and, wonky. It was like, oh, cool, interesting new take. And this is basically kind of, I don't want to say final form, but we're more or less at that point where you pick it up and you go, I mean, I was shocked when I picked it up to just how thin and light it was compared to the prior generations. Bob's right, the price is still wild. One of the big things I want to point out with the Fold in particular is, I've used these for a long time. The front screen has always been a little bit too narrow. So I would be trying to type with my big fat thumbs and, I'd be, pressing the wrong buttons or whatever. And people would think that I was typing in, I don't know, some kind of weird gibberish code or something. Now it's wide enough to actually fit like a regular size screen. So they did an amazing job here. Yeah, I mean, the Fold is amazing. The Flip is a lot more fun. Those are some of the pictures that I took because I'm a great photographer. I'm looking for a side gig too. I really can't, say enough about these phones, except for the price.
Mm-hmm. I mean, and that's the issue. And the thing is, the other thing, too, I will say one concern that people also had is how durable these things are going to be. And again, early phones, the first version, it was a screen scratching issue that became a big problem, and the durability of the device. But they've done all this work internally to address that. So, and Dan, I'm glad you brought that up. That aspect ratio change, that is the width versus height of the screen. When Google came out with the Pixel Fold 9, they really got that right. And now, this new Fold 7 from Samsung has that same basic kind of aspect ratio. So you can use it as a regular phone and not feel compromised, not have that tall, skinny, awkward to type on experience, but then again, get the bigger screen. It's an Android device. That's the other thing we have to say, right? In the US, there's obviously a very strong bias towards, iOS. But, to me, I think they've really done a great job with this.
All right, now we wait to see if we get an Apple foldable phone.
Yeah, they will do that.
Have Dan review that as well. Dan, thank you, sir, as always. And a big thanks to Bob O'Donnell for hanging with me all afternoon. Some final quick thoughts, Bob, for the tech investors listening.
Well, look, I think tech it's such an interesting time to be, tracking tech industry trends as I do and seeing where things are going. We have this opportunity with AI in businesses, in the sovereign world, obviously in the cloud, and now on devices too. So that's the other interesting part of this whole story. And, this idea of what I call hybrid AI, where you're going to do some AI on your device, some of it's going to go to the cloud. You're going to have a little bit more control than you've had in the past of where that data is stored, how it's being used, but the combination of being able to do that as a consumer, both in the cloud and on your device, and for businesses, a combination of the cloud within their own AI data centers and on corporate devices, also becomes very interesting. So there's a lot of work to be done. Again, still early days, not enough training being done at all to get people to really understand how to best use these devices by the vendors to get the features more discoverable. So I like, oh, wow, I didn't know I could do that kind of experiences.
Bob, always great to see you and to have you on the show.
Thanks,
Thank
Josh.
you, sir.
Appreciate it.